Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today our guest is John Brickson. Thanks for being on the show, John.
Hi, Whitney. Thanks for having me.
I'm honored to have you on the show. I know you and I have met up numerous times when I've been in Dallas, and it's been a pleasure to get to know you a little better each time. And looking forward to this conversation, no doubt about it. I know the listeners are going to learn a lot and are expecting, just learning about what's happening in the financing market right now and what's happening. And I know you're going to bring the content they're looking for. So, but a little about John. He's the director with Old Capital and based in Dallas, Texas. He and his team at Old Capital are actively involved in arranging financing for commercial real estate properties with a specific focus on B and C multifamily properties. Prior to joining Old Capital in February of 2018, he underwrote and financed over $1 billion
yes,
in
sir.
commercial real estate loans as a lender with a bank and a debt fund. So, John, thank you again. Why don't you give the listeners a little about who you are, what you're doing in this business, your specialty, and then let's dive into this topic, just the current market conditions with financing.
Sure. And Whitney, thanks again for having me on. And I have to compliment you. I've been on a few different podcasts, and I've been a listener of your podcast, pretty early on. I've been impressed with the content you've put out. And I've got to say that the podcast that I've been on, this is probably the easiest one to prepare for because you give the full playbook to who's coming on. So for anyone that's interested in being on a podcast, I definitely recommend getting on Whitney's. But yeah, Whitney, thanks again for having me on. I guess first I'll give a little bit of background. You gave some background on Old Capital, but a lot of people know about Old Capital because of our podcast. We started it about 4 or 5 years ago. It's hosted by Paul Peebles, who's the managing partner of Old Capital, and then it's co-hosted by Michael Becker, who at one point was a lender at a large national bank, and then eventually went into multifamily syndication and has bought and sold 8,000 units during this cycle. So a lot of people know us through the podcast, but full-time, we are a commercial mortgage broker. Our focus is on value-add multifamily properties. A lot of the loans that we do are in the Texas, and especially in the Dallas-Fort Worth market, but we do work nationwide. So since I've joined Old Capital, I've done loans from Seattle to Virginia. Closed one in Atlanta last month. Hopefully signing one up in Columbia, South Carolina this week, and even up to South Dakota, Minnesota, of course in Texas. So we're active across the country, and I'd say 60 to 70% of the loans that we do are Fannie Mae and Freddie Mac. 20% are non-recourse bridge loans, and then the balance is really kind of a split between banks, CMBS, and credit unions. And overall, we're very focused on multifamily. We've been doing this for a long time, and we really pride ourselves on putting people into business. So some of our largest clients that we have today, we financed their very first acquisition. They had no multifamily experience when they first started working with us, and now they've got over 1,000 or 2,000 or 3,000 units. So certainly like working with newer investors, but also experienced multifamily investors. And so to give you some background on me specifically, I'm a director with Old Capital. I'm based in Dallas, and I've been in commercial real estate financing since I graduated from DePaul University in 2011. First started my career at a large bank in Chicago, and then worked for a couple of different debt funds in the Dallas market thereafter. So I was lucky that early on in my career, I was able to focus on all different types of property. I financed multifamily, hotel, industrial, retail, office, self-storage, et cetera. And through that experience, I decided I really wanted to focus on a specific property type. And I really honed in on multifamily because what I saw, what I experienced was that during the downturn, you saw the fewest defaults and the fewest loan losses in multifamily. But then when the market recovered, that's where I was seeing people with the best returns and and really kind of the best upside. And so I felt like multifamily, is the most liquid of the property types, and it's most important of the property types too, because ultimately you're providing homes for people across the country. And people do say it's a feel good business, and it is kind of corny, but it's true. So it's rewarded in that way as well. But yeah, I got to know the guys at Little Capital and Paul Peebles, just as being a lender and active in the market in DFW, and had the opportunity to join Old Capital in February of 18. And so it's been a great ride so far, and had a great 2019. Looking forward to even better 2020.
Nice. So, I'm wanting to just draw from your experience, your expertise today, and really give the listeners, just kind of the current state of the market with financing, and what they need to be thinking about when they're thinking about, coming to you for agency debt, and or maybe some things that's happened in the past, the past year, that we need to be aware of, when we're thinking about financing, or maybe just catching us up to date with what's happened with Freddie and Fannie, and what we need to know.
Sure. Yeah, it's been interesting last year with Fannie Mae and Freddie Mac. So basically, the big change recently is Fannie Mae and Freddie Mac. They announced their new caps and their new limits for how much they can lend over the next 5 quarters. So in the past, the way it's worked is Fannie, the government will basically give Fannie Mae and Freddie Mac an allocation of how much they can lend each year. So 2019, their allocation was $35 billion for each group. And of that $35 billion, that did not include what loans that were under the Green program, and also did not include loans that they considered to be affordable. And so basically what happened was there was this big incentive for lenders to do green loans, and green loans, the interest rates were much lower than they were for non-green loans. And so basically everybody was doing green loans, and through September of 2019, Fannie and Freddie, had each done about $70 to $75 billion in total production, and then only about $30 billion was included in that cap, because so much had been considered green. And so what happened was in September or around that time is that Fannie and Freddie basically started to run out of funds to lend. They were running up against their caps. And so what they did is they tried to slow things down a little bit by really increasing interest rates, dialing back the interest only, not granting waivers for credit or for pricing. And so they really pulled back quite a bit. So finally, October 1st, FHFA announced new caps where they would allocate $100 billion to Fannie and Freddie. But of that $100 billion, they could no longer exclude green loans or affordable loans. And so affordable loans aren't excluded, but Fannie and Freddie are required to finance, at least 1/3 of their business has to be on affordable properties, or properties that they consider to be affordable. And basically, affordable would be not necessarily Section 8 or subsidized or LIHTC type housing. Affordable really just means that the in-place rents are below a certain percentage of the area median income. And so what we've seen is that there's this new cap where they can do up to $100 billion in total production over the next 5 quarters. But green loans are no longer excluded. So there's really not much of an incentive to do green financing with Fannie and Freddie. So we're not really seeing green loans being done with either at this point. And then there's a big incentive though, and there's certainly a push to do loans on properties that meet that affordability criteria, which they actually call mission rich. And so if it meets that mission rich business, then we've seen people are much more likely to get those interest rate waivers and those waivers for interest only, and all those extra incentives to finance with Fannie or Freddie. The other thing I would say too is they have, since they announced the new caps, I think Fannie and Freddie have gotten more aggressive than they were in August, September, when they were running out of funds to lend. But I don't think they're quite as aggressive as they were probably first part of 2019. They haven't come all the way back yet. There are certain areas where we're seeing Fannie and Freddie start to be more cautious. I'd say for one, Freddie Mac and under their small balance loan program, traditionally they've been pretty lenient on financing newer or first time multifamily investors, where as long as you met that net worth requirement of having a net worth equal to 100% of the loan amount, and then liquidity equal to 9 months of principal and interest, and you hired a third-party property management company, you could finance with the Freddie Small Balance Program, even if you or none of your partners had multifamily experience. And now they're pushing back on that a little bit. They're wanting to see people that have experience, or at least someone that's local in the market. So they're not as open to financing someone that's based in California, that's buying a property in Texas, and it's their first multifamily acquisition. They typically want to see someone that at least is local. And they still are granting pricing waivers and granting credit waivers, but they're much more likely to give those waivers for those properties that are considered affordable.
Okay, so a lot of great tips there that you were just throwing out there, and I wanted to clarify just a couple things for myself and the listener. But affordable properties. So and going into, I wanted to hear too, like how much have you noticed, like someone's experience playing a role in getting debt now versus, let's say, a year ago, with these changes?
Sure. Yeah, I mean, it's really important. Fannie and Freddie are definitely pretty focused on who is part of the sponsorship, who's part of the team, what that experience looks like. They're looking at everyone's schedule of real estate owned, and they want to see how the properties on your schedule of real estate owned are performing. If any properties are not performing, they want a pretty clear explanation on why it's not performing. And, those are really for, those, especially if it's a loan where you've signed as a key principal or as a guarantor, they want to know kind of what the history is on and what's the background on it. But yeah, experience is very difficult. I mean, I'm doing a loan right now that we're closing, that's in New Mexico, and it's in a market where there's a pretty strong, it's a smaller market, and it's also a large concentration of oil and gas industry. And, Fannie looked at it early on, and we screened it with them on the front end, and they said, we're comfortable with this, we'll do the loan, but we really want someone in the partnership that has significant Fannie Mae experience or significant multifamily experience. And what that really meant was, experience, of at least 5 years, at least, 10 Fannie Mae loans that they've signed on. And so that's what we ended up doing was bringing in an experienced partner who could sign with them. And that allowed us to get over the hump and get qualified. So experience is still, has been important and is as important as it's ever been, I would say.
Wow. Okay. So, because I know a lot of listeners are thinking, well, how am I ever going to get that agency debt? What am I going to do? Especially if it's more difficult now, if Freddie and Fannie have tightened things up a little bit again, how am I going to get to that? And so I'm glad you brought that up, like bringing in an experienced partner. And could you just elaborate maybe what that would look like a little bit, or how do we bring somebody in like that? Who should we be looking for? Maybe the listeners networking at events now, and they're talking to people, and who should we be thinking about for this experience specifically for the debt?
Sure. You want to bring someone in that is has actually signed as a guarantor on a Fannie Mae or Freddie Mac loan, or maybe it's even a bank loan, but at least has some experience as a general partner, as an operator, as a managing member of an entity that owns multifamily. That's what qualifies as experience. And then, if they have experience in the market that you are acquiring a property in or that you're looking in, that's even better.
Okay. So as we're having those conversations and we're figuring out, okay, who's been a part of what deals, we need to be thinking about, have they signed on debt before? And maybe clarify, signing before, okay, that could be experience, or it could, maybe they had the balance sheet. Maybe you could elaborate, because I know in the beginning it's confusing. Well, do they need both? Could it be somebody for one of those pieces, or, tell the listener about that.
Sure. Yeah. I mean, I think anyone that's signing as a guarantor, it makes more sense if they're bringing something to the table. And that's another area where, and I'm glad we're bringing this up, because that's another area where we're seeing pushback is that, over the last few years, there's been, a lot of people that are buying multifamily properties, and they're bringing in, 6, 7, 8 different key principles to sign the loan. And some of these key principles, they might just be purely passive investors with no voting rights or no control at all within the entity. And so what we're starting to see, on some Fannie and Freddie loans is Fannie and Freddie saying, well, wait a minute, why do we have 7 different key principles, or 8 different key principles on this $3 million loan? And so I've started to see that the agency is really kind of capping how many people can sign the loan, because the way they look at it is, it's too many cooks in the kitchen. And if there is some kind of dispute at the partnership level, it's hard enough to resolve it if there's 3 people that have signed a loan. But if you have 6, 7, 8 people, it becomes even more difficult. So overall, what I would say, if someone's signing a loan, they should be doing, one of a few different things. That can be they're doing part of the asset management. Maybe they're the boots on the ground. Maybe someone's buying a property in, the Kansas City market, and one person's based in Kansas City, and then the 3 other partners are based in, one's in California and one's in Boston, and someone else is, in Texas. Maybe you're the boots on the ground and you're handling a lot of the asset management in the day to day. It could be someone that sourced the opportunity and found the acquisition and did a lot of the underwriting. Or it could be someone that just has the net worth and liquidity and is providing that balance sheet support that's needed to be able to qualify for the loan. But I think, what they don't want to see is someone that's just signing, that's not investing any money into the deal, and then, is really just along for the ride and, getting a piece of the deal just for signing as a guarantor on the loan.
And how are they going to know that? I mean, I just want you to elaborate a little bit. How are they going to know that?
So, during the underwriting process, they're taking a deep look into who's on the org chart, what's the role in the org chart. They're reviewing the operating agreement of the borrowing entity, and then, also looking at the total equity raise and wanting to see a breakout of, who's investing and how much are they investing. So, it's all part of the actual underwriting process. They're not going to know all these details on the very front end of the transaction. But, it will come up in the actual underwriting.
So I know, it's becoming, or it seems like a more bigger topic recently about bridge debt as well. And I thought maybe you could spend a few minutes elaborating on that, and maybe why we should be considering it, or maybe why we shouldn't.
Sure. Yeah, I've been more involved with doing bridge loans over the past couple of months. So I closed a bridge loan on a 196 unit property in the Atlanta market back in October, and then I'm closing on one here in Fort Worth in the next week or so. But yeah, we are starting to see more people do bridge loans. A lot of it is the property won't qualify for Fannie or Freddie, in its current state, and so. For instance, the property that I financed in Atlanta, the property was stabilized. It was 94% occupied at acquisition, but the in-place expenses were really high. The historical utilities were really high. The historical R&M was also really high, and then the rents were well below market. And so, the borrower that was buying this property, they owned another property in the submarket. That was a newer property. It was 2000 construction, where this property was 1989 construction. But it was, similar location, and the rents at their other property were $400 above the rents at this property that they were buying. And so their thought was, number one, it's tough to get Fannie or Freddie financing on this, just given the in-place financials. But then two, there's a good amount of upside here. So if we buy this property and we're able to increase our NOI by 20, 30, 40%, it'll be much easier for us to do a cash out refi into a Fannie Mae or Freddie Mac loan once we realize our business plan, or to sell the property. And the reason it's easier is because the main benefit to me with a bank loan or a bridge loan or a non Fannie Mae or Freddie Mac loan is the prepayment penalty. So with Fannie Mae and Freddie Mac loans, you typically have what's called a yield maintenance prepayment penalty. And if you're in a situation where you want to sell the property in year 4 or year 5, you either have to pay off the existing loan and pay that prepayment penalty, which can be really expensive, or the buyer has to assume the existing loan and do a supplemental. And so a lot more people who've had more experience in multifamily and have financed maybe their first 2, 3, 4 acquisitions with Fannie Mae or Freddie Mac financing are finding that when they've gone to sell the property or they've gone to go refi the property, that they're having to deal with these yield maintenance prepayment penalties, and so they're opting to go with a floating rate loan or a bridge loan that they can exit and is a much better fit for the more transitional properties.
What disqualifies us from getting the agency data through Freddie and Fannie?
So Fannie Mae and Freddie Mac loans are really driven by the in-place cash flow on the property. And so Fannie and Freddie, they'll go up to 80% of purchase price in most markets, but the loan has to be able to cover, or the in-place net cash flow has to be able to cover the annual principal and interest at least 1.25 times. And so if you're buying a property, and if you're buying it at a really low cap rate, just because the in-place cash flows are lower than they should be, or the property is not operating as it should, then you're not going to be able to get very high LTV with Fannie or Freddie just because of that 125 DSCR constraint. And so that's a lot of it too, is that, bridge loans, they don't have the DSCR constraint. Some bridge lenders, they'll go down to a 1.0. Some will even go below a 1.0 debt service coverage on the going in financing. And so you don't have that restriction as well with bridge loans.
And what about occupancy?
And then same thing with occupancy. I mean, there's no restrictions on occupancy. Fannie and Freddie, they typically want to see physical occupancy of at least 90%, economic occupancy of 80 to 85%. Bridge lenders, they'll finance properties, and all bridge lenders are different, but there's lenders out there that'll finance properties that are 50% occupied, 40% occupied. We don't see too many of those in the current market just because there's just not as many distressed properties in the current market, but they do not have occupancy or minimum occupancy requirements typically.
So what are some of the cons from the bridge debt? Why are so many more people moving that direction? And what do you see, say 3 to 5 years from now happening with this bridge debt?
Sure. Yeah, I mean the risk with bridge debt, or the downside of bridge debt, I guess, is that they are riskier. Then it's riskier to finance with a bridge loan than it is with a Fannie Mae or Freddie Mac loan, simply because bridge loans are shorter term loans. They typically have a 3-year term with 2 1-year extension options. And so you can get to a situation where you buy a property, you execute on your business plan, but within the next 30 months, there's a recession. And even though you've done your part, even though you've hit your projections, everything else can be great, but the financing market can completely go away during a recession where lenders simply aren't lending. Fannie Mae, Freddie Mac can really pull back, and so you can be in a spot where you did a bridge loan 3 years ago, and maybe you were 80% loan to cost, but cap rates have increased. What's called liquidity, basically funds available in the market has dried up. And now you're in a situation where there's a downturn and you have to refi during a downturn. It's much more challenging to refi during a downturn. And, if you don't have enough cash on hand yourself as a sponsor, or if your investors aren't willing to fund a capital call, you could be in a situation where you're just over leveraged and you can't pay off the existing loan. With Fannie and Freddie, if there's a downturn, you might have a reduction in your cash flows on the property or occupancy on the property, but hopefully you're still able to make your principal and interest payments and then ride out that downturn through the next 6, 7, 8, 9, 10 years, however much term is left on that Fannie Mae or Freddie Mac loan. And then once the loan does come due, 10 years after you've acquired the property, you've had enough principal pay down during that term that you're in a spot where you can either refi the property or you can sell the property and still be able to pay off a loan just because you've had enough principal pay down. So with bridge loans, shorter term maturity, they're typically interest only, meaning there's no amortization or no principal pay down during the term. And so with that, you can be stuck in a spot where you've got the gun to your head type situation where you've got to pay it off and there's no lenders in the market.
So, how sure are you, or when is it decided if you get the second or the 1 year extensions? I know we do the 3 year plus one or 2 1 year extensions. Is there a time where, okay, the end, we're planning to have those extensions, but the market takes a dip or dive, and now it's like, sorry, you don't get those extensions now.
Sure. Yeah. I mean, that's definitely something that if you're a borrower, you want to pay close attention to the language that comes with the extensions that's in the term sheet. So usually, with the extension, you'll have an extension test where the property has to be at, let's say a 1.10 debt service coverage or a 1.20 times debt service coverage. So typically, there's an extension test where the lender will go and reappraise the property. So the property needs to appraise at, could be 80% LTV, 75% LTV. It's all negotiable. There could be no appraisal test at all. It could be an appraisal test and then also a debt service coverage test where they're looking for, a minimum debt service coverage. It could be minimum debt yield where they're looking for property has to be at, a 7% debt yield, and a debt yield really is that's your NOI divided by the loan amount. And so you can be in a spot where, maybe the property doesn't meet that extension test. And so in order to be able to meet that extension test, you have to pay down part of the principal on that loan to get it back into compliance. And then you can extend. And usually with each extension, there's an extension fee. And that extension fee can be, depending on the lender, it can be 25 basis points for an extension to a full point for an extension.
Nice. So could you just, and we're going to have to move on. Unfortunately, we're about out of time, but I know you said, 25 basis points to 1 basis point. Can you tell the listener that's thinking, what in the world is he talking about?
Sure. Yeah. So 25 basis points, 25 basis points is basically 1/4 of the loan amount. So, 1% is 100 basis points, 0.5% is 50 basis points, 1/4% is 25 basis points. So when I say, a 1% extension or a 1% extension fee, it would be, 1% of the loan amount to extend the loan.
Awesome. No, I remember when I first started and people were talking about basis points. I'm like, what in the world are they talking about? So I appreciate that. But a few questions before we run out of time, John. Tell me, as far as, maybe on the financing side, when we're expecting this potential downturn that everybody's talking about, how do we prepare for that?
Yeah, no, that's a great question. And I like that you asked, how do we prepare for it? Because, people often ask, when's the downturn coming? And no one can really know when the downturn's coming. You can never know, but you can be, hopefully prepared. And so to me, the best way you can be prepared is really, financing component is definitely important. Having long-term fixed rate debt, as we talked about, is a key way to mitigate your risk and mitigate your downside. So, if possible, if you can finance the acquisition with a long-term fixed rate loan, you can do that. Or if you have bridge loans, make sure that you have enough cash reserves on hand so that if there is a downturn and, if you do run into a situation where you need to pay down part of the principal to meet an extension test or pay down part of the principal to be able to refi your bridge loan, you want to make sure that you have enough cash on hand. So to me, the two key things to ride out a downturn are really just, long-term fixed rate, non-recourse financing on your properties, and then also having enough cash on hand to be able to ride it out if needed.
So no floating interest rates right now?
Well, you can have floating interest rates, and I think there's certain cases where it makes sense to finance with bridge, and I think there's certain borrowers that are at that level in their career where they can handle doing a bridge loan and where it works. And with floating interest rates, actually. A lot of investors, for instance, Michael Becker, who's, with our group, he's financing some of his properties with floating rate loans, but they're lower leverage floating rate loans. And so, what he'll do is he'll finance it with a 5-year floating rate loan or a 7-year or even a 10-year floating rate loan, where the prepayment penalty is much lower, and he can pay off a loan in year 3, 4, 5 if needed, and avoid the yield maintenance prepayment penalty. But with those floating rate loans, you can buy what's called a LIBOR cap, where basically you're able to put a cap on how much the rate can increase, is what that is. It's really a hedge. And so,
insurance. Yeah,
it's insurance. Exactly. So, there's no one size fits all, as in the lending world, and, every property and every sponsor, there's different types of loans that are best fit for them. But the two key things to remember is, just having cash on hand is important. And then also either, long-term fixed rate debt or, ideally lower leverage debt on your properties as well.
So what's the number one thing that's contributed to your success?
Number one thing that's contributed to my success, I think, is really just being persistent. And, just keeping your head down and trying to learn from your failures and learning what's not working. And then, obviously you want to be patient and stick with something, but, that's, that could potentially work. But, I think just persistence is important. And, one book that I liked was, Seth Godin's book, The Dip, which really talks about, sticking with, something and being able to get over that dip, because once you get over the dip, it's much better on the other side. So I'd say that's the number one thing, is just being persistent.
And how do you like to give back?
So, admittedly, one thing I'd like to do a lot more of in 2020 is giving back, but I was just back home in Kansas City, for Thanksgiving. And, my mom has always been a great role model. And that way, she's a very active volunteer. And on the Wednesday before Thanksgiving, we volunteered at our church, and we hosted a big Thanksgiving dinner for the underprivileged, about 200 underprivileged families and individuals. Did that the night before Thanksgiving. And then on the Sunday of that weekend, we went and volunteered at basically it's a gift drive where there's all kinds of different gifts, presents, clothes, appliances, whatever, where 900 families will come in and can shop for Christmas. And I'd say, those two things were really the most enjoyable part of my Thanksgiving weekend, and would love to do more of those types of volunteering opportunities.
Nice. I appreciate you sharing that, John, and giving back in that way. Appreciate your time today. It's been a great show, and I can't thank you enough, because I know all the listeners are wondering about financing and how we need to get financing and what we should be thinking about, especially, with the market, the way everybody says that, it's probably going to happen in the next year or so. So thank you again. Tell the listeners how they can get in touch with you.
Sure. You can send me an email. I'm at jbrickson, JBRICKSON @oldcapitallending.com. And then you can find the rest of my contact information. If you go to oldcapitallending.com, my information's on that website as well.
Thank you for listening to the Real Estate Syndication Show, brought to you by Life Bridge Capital. Life Bridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. Life Bridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.